Should you be buying tech stocks right now? With the Dow Jones Industrial Average down 4,000 points since its all-time high in January, there's no denying that Wall Street has had some trouble lately. But despite the instability, some of today's most successful investors are still investing in tech stocks. Should you be buying too? Here's what top investors have to say about the value in tech stocks right now and which companies they think you should buy if you do want to put your money into tech stocks. The case for buying. With all due respect to what looked like it could be a tech bubble popping in February, Jeff Reeves is correct when he says that the dirty little secret here is that it's going to get worse before it gets better. But don't be fooled by headlines and pundit panic. It might actually be time to invest in some of these companies again. Of course, nothing will change if you don't know where to look. With that in mind, let's take a quick look at some of Jeff Reeves' favorite picks. Facebook, FB, has been a laggard with investors recently but should see a rise as mobile advertising and ad sales grow over time. Apple is still an industry leader and boasts one of the highest dividend yields around. Google, despite its recent troubles, continues to innovate in its core search business while branching out into others such as self-driving cars and wearable devices. And Twitter, Twitter is starting to show signs of life after years of being left behind in social media. All four stocks are up since their lows earlier in 2016. As Jeff Reeves concludes, now is not necessarily a good time to buy tech stocks. But it's also not a bad time either. I think we may have hit bottom for now, so now would be a good time to start looking for opportunities in technology stocks. How you should be investing. Technology is transforming every industry, and right now it's creating a host of opportunities for investors. If you are looking to add a tech stock to your portfolio, you should be investing in the most innovative companies that make products and services designed to meet those changing needs. When identifying tech companies to buy, there are 5 key things you should consider: opportunity, capital efficiency, research development, R&D, management quality, and growth potential. Once you understand how each company measures up against these 5 metrics, you can make an informed decision on whether or not they fit into your portfolio. Keep in mind, though, that even with top-notch technology companies, not all stocks are created equal. And just because one company scores well doesn't mean another similar company will perform just as well. That's why you should always do your own due diligence before buying any stocks, especially when investing in volatile industries like tech. To find out which technology stocks might be good fits for your portfolio today, keep reading below. Opportunity. The first thing you need to look at when evaluating tech stocks is their opportunity. How much money does the company have at its disposal, both in assets and cash flow, compared to its market cap? High ratios here tell you that there's still room for future expansion despite having reached high levels of success already. This means less risk over time since new innovations won't put pressure on earnings as they become more established, while offering greater upside if profits continue to rise. Capital efficiency. One important aspect of assessing capital efficiency is understanding how far sales dollars go compared to other expenses. Where you should be investing. While it's tempting to time markets, you might have heard that buying stocks at low points is a surefire way to make money. That's rarely true in practice. If you buy tech stocks when they are on a slight decline, there is still a risk that their prices will fall even more once you own them. To avoid those risks and stay invested, stick with what works for your portfolio. Fundamentals trump market timing any day of the week, so while tech stocks may be down right now, don't think about selling just because other people are nervous. Instead, look at how well your investments fit into your overall financial plan and adjust as needed. For example, if you have an aggressive growth portfolio but want to take some profits off the table during a downturn, consider switching some of those funds over to bonds or cash instead of selling out completely. This strategy can help smooth out bumps in your overall portfolio without forcing you to sell off good investments altogether. It also helps keep you from making rash decisions based on fear. As Warren Buffett said, "Be fearful when others are greedy and greedy only when others are fearful." Who you should be listening to. The folks at Goldman Sachs have put together a list of investors to pay close attention to when it comes to tech stocks. Among those they suggest, you'll find Bill Gurley and Ben Horowitz, who are co-founders at Benchmark Capital, Peter Thiel and Chamath Palihapitiya, who are partners at Founders Fund, Josh Kopelman, Ron Conway and Max Lev China, who's now chairman of Affirmo at Khosla Ventures, Jay Hogue, Mahendra Ramzanani and Tom McInerney at Redpoint, Matt Kohler, George Zachary and M.G. Siegler from Benchmark, Reid Hoffman from Greylock Partners. A word on timing: it's true that during recessions, investors tend to flock to safe havens like technology. Just take a look at what happened during both of our most recent recessions. The S&P 500 Information Technology Index rose around 110% and 200%, respectively, in less than 2 years following each one. However, it's important to note that tech stocks did not perform as well during other periods when markets were healthy. For example, they declined by more than 50% between 2000 and 2002. Technology is no doubt a solid long-term investment choice. However, there are some risks associated with buying into these companies right now given their lofty valuations. For example, some experts believe tech giants such as Facebook Incorporated, Amazon Incorporated, Netflix Incorporated, Alphabet Incorporated, Apple Incorporated, etc.